So how you guys feeling? Crazy ride, right? Crazy ride. Yeah, ups, downs, all over the place. Who know? It's like who knows what's going to happen tomorrow? Well, today's Friday, so Saturday doesn't matter. Who knows what's going to happen any day of the week as far as the market goes? I've got a survival guide for retirees and non-retirees, those within 10 years of retirement, 6 steps for each that I will give you as a way to combat the market crash. Guys, leave me some comments. How you been feeling now after a week plus of this? Good, bad, have no idea? And I'm getting all this information from Morningstar. So let's start out with the retirees. 6 steps to feel better. A survival guide during a market crash, and I'll be reading these, so I'll be going up and down. So it's actually another version of story time with Uncle Duane. Here we go. Number 1, check your liquid reserves. Again, this is 6 steps for retirees. Then I will get to those for non-retirees. Number 1, check your liquid reserves. What does that mean? Your cash on hand. In times like this, you should have at least 2 years of cash on hand in times like this. Some of you may go more than that, but if you're going less, I don't know. In normal times, it might be okay, but now, yeah, I think you need at least 2 years. So you've got the money on hand, so you don't have to dip into your investments during a bad market, which just solidifies and actualizes your actual losses. If you haven't dipped into it, you're just down on paper. Number 2, recalculate long-term asset allocation. Okay, when markets go up and down, and also just over the years, no matter what kind of allocation you have, it's going to move all over the place. For instance, earlier this year, I thought it was at 57% stocks to bonds. I went in there last week and I found it's down to 55. In this market, I'm okay with that. Normally, I want to be closer to my 60-40 stock to bond allocation. So check. You got to look at your long-term asset allocations to make sure they're where you want them to be. Hey, for those of you who see me for the first time, my name is Duane, and this is a channel for retiring on moderate income. If you think you might like that, think about subscribing and like the video. And if you really like it down here, you can either buy me a coffee or buy my new thriller/dark comedy, The Monster Who Loves Me, for $3.99. Here's the 3rd step. Revisit your withdrawal rate. For those of you, I know that some of you are going like what I do. I go by the 4% rule. Even though I haven't had to withdraw from my assets in 2022 because of my YouTube and my cash, that's still my guiding principle. But in times like this, it helps to have flexible withdrawal rates, to guarantee the outcome, the good outcome of your long-term state with your investments. For instance, in times of stress, bad market, if you can go down in your withdrawal rate, that really helps. Look at the information out there for people who do a 3% withdrawal rate. It's basically 100% success over a 30-year portfolio horizon. If you can go back and forth on your withdrawal rate, in bad times, cut back. In good times, maybe spend even a little bit more. Go up to like 4.5%. Some people go crazy, go up to 6%. I'm not saying that. But you got to look at your long-term withdrawal rate and see what you can do about that, because there are ways to offset this bad market if you can just adjust your withdrawal rate depending on the time. Number 4, identify tax-saving opportunities. You can use losses to offset capital gains in times like this. So just because you're in a bad market doesn't mean there aren't other things you could look at. Guys, so much in this kind of market, it's like you feel like you've lost control, right? Some of these steps are ways you can maintain control on the stuff you have control over, because so much of this we have no control over. So in this case, identify tax-saving opportunities. That's one little step that might give you a little more confidence in a bad market. Number 5, find other ways to trim investment-related costs. I think the major one on this is expense ratios. You got to look. I hope most of you guys know how much you are paying. Number one, if you have a financial advisor helping you, I sure hope you know how much you're paying them. Most of them charge around 1% of assets under management. Outside of that, if you're an individual investor, I sure hope you know what your expense ratios are on the different funds that you have. If you don't, now's a good time to find out, because you might find some of those are higher than they should be or that you would like them to be. If you're in index funds, usually those are pretty low. Target dates, they can vary. Luckily, I'm in one with, I have a couple different target dates. I am lucky that I'm in a couple of those with very low expense ratios. So if you don't know those, now's a good time to find out. And finally, for number 6 under retirees, step away from the action. I mentioned this in my last video. 2 ways to do that I find very helpful. Number 1, news. Don't watch the news anymore. Or if you do, limit it. Really limit it. You know what I find for me? When I watch local news as opposed to national, there's a lot less of the overall economic picture going on and a lot less of national politics in the local news. That's what if I watch news now, it's local because it's more about local stories, stuff like that. Another way to do that, don't check your portfolio all the time. Like I've told you guys in my monthly update videos, I've gotten down to checking it once a month when I get the information to give you guys those monthly update videos. Outside of that, I don't check my portfolio. When I first retired, the first time I went through this sequence returns risk, I was checking it obsessively, sometimes daily. That's not healthy. So that's a good step to do to take control, to take more control over your situation. Okay, so let's get to non-retirees, those within 10 years of retirement. 6 steps for you as well. Number 1, perfect time to turbocharge your savings. And did I mention this? I got all this from Morningstar. I think I mentioned that at the beginning. Senility setting in again, guys. Turbocharge your savings. For those of you, especially those 10 years out from retirement, this shouldn't affect you at all. Bad market shouldn't affect you at all. This is time to just sock that money in dollar cost average. For those of you closer to it, okay, you could be feeling the effects more. Say you're 2 years, say you're a year out of retirement. Still, keep putting that savings in. And for most of you, that will mean you're probably over 50, where you can take advantage of those rules where you can increase your savings amount for 401k and IRAs. Do that. Number 2, take control of your retirement date. If you haven't nailed down your retirement date, now's a good time to do it. Okay? Especially if we're in a bad market. For those of you that don't have your retirement date set in stone already, there's nothing wrong if you want to push it out some. Okay? Retiring into a bad market like I did at the end of 2021, beginning of 2022, is not the way to go, guys. If you need to push that out, more power to you. No one is telling you you have to retire on April 21st, 2025, or else. Or else what? Or else. Take control of your retirement date. Nail it down. Number 3, revisit the safe portion of your portfolio. What do I mean by that? Well, here's what I mean. Cash and bonds. Maybe a good time now to look, cash on hand. What do you got? Especially for those close to retirement. You want to have at least 2 years, as I mentioned earlier in the video. Bonds. If you're getting closer to retirement, your bond asset allocation should be higher than it used to be. If you're in your 20s and 30s, heavy stocks. If you're 58, bonds. Yeah, it's a good way to go. Number 4, the counterpart of this, your asset. It's on my mind. What can I say? Assess your equity position. What's equity? Stocks. Are you comfortable if you are 2 years away from retirement and you are still 80% stocks? Are you comfortable with being that heavily invested in stocks? You got to look at where you're going to be when you retire. How are you going to feel when you're retired? If you're 10 years out, yeah, still stay heavy in those stocks. If you're a year out, I don't know. All comes down to risk tolerance. I am pretty risk averse. That's why I'm 55-45 stocks to bonds, which I'm thankful for now that I am. There's a lot of you that are retired leave me messages. I'm 90% stocks. If you can handle that, if you can stomach that, good for you. But just know where you're at, and especially where you're going to be when you're retired. Number 5, factor in the start of your Social Security. When are you planning on taking Social Security? Now, this may change, but just the fact that you have a pretty good idea when you want to start taking that, that can help you in early retirement. Let's say you are going to retire at 62, you want to take it to 65. Well, those first 3 years, you're going to have to fund those years mostly out of your savings, unless you have a part-time job while retired or side hustle, whatever you want to call it. You're going to have to fund those 3 years. So your investment portfolio is going to take a hit until you get to Social Security. Know when that Social Security date will be for you. And number 6, evaluate anticipated lifestyle changes. Guys, for those of you that haven't retired, believe me on this, your life will totally change when you're retired. Now, they say most of us spend 75, 80%, some even say 70%, depending on who you look at, of what we did spend when we were working. Know yourself on that. Me, I'm more like about 67, 68% I'm spending of what I was working. Know how your lifestyle will be in retirement. Take a trial run. 2 years before you retired, try living on what you propose to be your retirement budget. See if it works for you. Got to nail that down before you retire. It'll make it much easier. So there you go, guys. There are 6 steps for retirees and 6 steps for non-retirees of how to survive this market crash. It's a survival guide for you, from me, from the bottom of my heart. Anyway, as we speak here in LA and not the high desert, and from my good friends, you too, we got this.